The Financial Sense Friday edition with Jim Pavlava. Focusing on precious metals and mining.
And joining us on the program is John Eng. He's president and CEO of Maison Plasmon. John, I have a piece that just came out, very appropriate. It's called Gold, Sex, Lies, and Gold. And, you know, we've seen the former governor of the state of which I live. We've got the IMF scandal. And, you know, that seems to have captured the headlines of the media. But underneath the surface, there's a bigger problem going on, and that is we're on a collision course in this country with the amount of money that we're spending, and there doesn't seem to be an appetite in Washington to do any serious budget cuts, or if you do suggest it, you're going to be demagogued.
That's right. It is literally the train has going down the track at 100 miles an hour, and we all know how it's going to end, but nobody's doing anything. Nobody's pulling the switch, which is just truly amazes me. Even with the proposed, as we know, if you were going to hit the debt ceiling, which you did last week at $14.3 trillion, the world was going to fall apart. But then we found out Mr. Geithner could dip into the federal pension funds, and he's been able to forestall the day of reckoning to August 2nd. And at the same time, we have politicians, Bill Clinton included, saying, oh, well, maybe we should just default for a few days. Well, it's sort of like being half pregnant. You can't be half pregnant. You either default or you're not going to default. And my big worry is that you are going to default. There have been shutdowns in the past. In 95, 96, I can recall there was a 21-day shutdown. But when you look at through history, there's been 10 actually shutdowns, and so it's nothing new.
You know, I don't think for the average individual understands the word or meaning trillion. I mean, we used to talk, when we talked about budget deficits, when we talked about debt, we used to talk billions. Now there's trillions. I mean, if you think about it, the administration is going to spend, the federal government this year, $3.8 trillion, of which $1.7 trillion is going to be borrowed money. So every bullet that we fire in a war, every missile we launch, every check that we send is paid for roughly over 40 cents in borrowed money. No nation, no country, no company or individual can operate along those lines. So I guess the big question is, John, you think they're probably going to end up defaulting. Can they get lucky and postpone this? I don't see how they can do this for another 2 years.
Well, in my piece, Sex, Lies, and Gold, I look at the options that you have. One is you could, as Canadians did one time when we had a huge debt, we bit the bullet and we went on an austerity program, and fortunately everything worked out. On the other hand, you can do what the Europeans are trying to do, is that they are just putting Band-Aids over it. They are lending countries more money, but that doesn't solve the problem. That doesn't extinguish any debt. It just postpones the day of reckoning. And that is what I believe what Bernanke is doing, everybody knows about the election calendar. 2012 is coming up, and let's put off the problems until after the 2012. And in the interim, we've had quantitative easing 1, quantitative easing 2. What does that mean? Printing money. Unfortunately, by printing money, it has inflationary implications. The other alternative, of course, is to borrow from the Chinese and whomever that will lend you the money. But the reality now is that the Chinese have said, well, we already have enough dollar obligations. We're going to diversify. So they have been buying companies. They have been buying copper. They have been buying gold. They've been buying oil. All assets that are denominated in dollars, but not treasuries. In fact, for 5 straight months, they've reduced their treasury purchases and they've been absent from the market. So the Fed has been printing money to fill the vacuum, and of course the Fed's treasury balance sheet has gone over $3 trillion. And my very much concern is that it's sort of like I call it the great fiscal Ponzi scheme, that when you run out of players to buy your paper, that's when the jig is up, as we found out with Madoff. This time, we are looking at the calendar, and August 2nd is coming around, and already the Chinese have stopped buying. Already the Japanese have said, well, we've got other things to do with our money. The reality is that the signals are there that people are not buying your paper. And if they don't buy the paper, then interest rates will either have to go up, or in fact, if there's no agreement by August 2nd, there is that risk of a potential default.
And if it was just the federal government, but as you highlight in your newsletter, I think the deficits for the states this year is a figure of close to, I know it's over $120 billion for all the states, and I think next year it's $75 billion. So, John, it's not just that the government is in major debt. My own state of California, we're basically broke. So it's a national problem, but it's also a state problem and a city problem. We've got cities here that are filing bankruptcy. They can't pay their debts. I'm absolutely amazed that we have been able to go along at this level. And even the president's, I had Senator Simpson on last week, and he said, unfortunately, we're in an election cycle, so there isn't any stomach in Washington to do any cutting, because if you do, you're going to get beat up in the press. So what happens when we come to August?
That's a very good point, Jim, was that last year the states were also in a very serious problem, but a good part of TARP program was funneled down to the states. So that forestalled the problem, and they were able to pay the teachers, etc. This go-around, you're quite right, is that the deficits are even large, and I've seen numbers to the tune of the $29 billion of expiring bank guarantees in this current quarter's coming up, and somebody's going to have to come up with that money. And then on top of that, there's the cost of the state and local governments. $1 trillion is the cost for the employees alone. And that's why we're seeing some states are wrestling with their union contracts now, and they have no alternative. So my sense is that they can't print money like Mr. Bernanke can, and thus they have to look at services and cutbacks and revenue enhancements, and all that means is taxes go up in an election year. My concern is that in trying to forestall it, you're just trying to buy time, and the clock is 1 minute to 12, and not to sound alarmist, is that you only have to look at the action in gold. Gold has been climbing, as is all the precious metals, because of their other investors are sort of looking ahead and saying, look at all these problems, I better have some gold.
But something that I think that makes our situation a little different now, and maybe it was a little different than when Canada got its house in order, John, and that is, I think the latest Treasury figures show that close to 50% of our debt or more is owned by foreigners. So now we have huge creditors. And I know when QE2 was announced, China and many other countries around the globe were not too happy about that. So if Bernanke tries to forestall with QE 3.0, can we wake up one day when our creditors say that's enough?
Well, my concern is not to wait to when the creditors say that's enough. I think that the fact that gold records new highs, the fact that you're seeing other markets doing much better, gold even in euro terms just hit a record this week, are telling you that already some of the big creditors have already made their bet and hedged their situation. And that's what I think that is what has been going on. While politicians are trying to buy time, investors aren't just going to wait around for the bell to ring. They are already taking steps to protect their assets. And that's the attraction of gold and gold stocks, is that as the U.S. dollar goes down, as the purchasing power of your dollar goes down, there are mechanisms to hedge oneself against the declines.
Yeah, one thing that I think caught a lot of people in the market, and they all came out about the same time. We had Standard & Poor's put the U.S. on a credit watch. We were downgraded by China, which nobody paid any attention to. And then the world's largest bond fund manager basically said, I'm out of the dollar. But, John, it surprised me. Yields are lower, today than where they were when all three of those announcements were made.
Yes, yes. That's the magic of printing money, is for a time you can fool the people and investors. But the smartest bond people, PIMCO, he has no U.S. treasuries anymore. His portfolio manager's largest position on the global portfolio is in gold. Rates are down, but they're not going to stay down very long. Same thing in Canada is happening. We are seeing a creeping in rates. In China, they've already had an increase in rates 4 times now. We're seeing this in the UK. The reality is rate structure is moving up, and one of these days in America, there will be a dramatic increase, particularly when the problem is when to refinance the next tranche of redemption. And the reality is that you can only hold up the market for so long before the market would just cascades over you.
Now, this to me, as your article, all roads lead to gold, and I think that's what if 10 years ago you and I were having this conversation and we were to tell our listeners we'd be talking about $1,500 gold, $2,000 gold, $7,500 silver, they would have thought we were nuts. But a question that comes up, gold has done well. This year, gold's up just slightly. Silver had a nice, gold's up 7%. That's the 11th year that we've seen an increase in gold prices. Silver's up 20, even after a setback, after being up 80% last year. But we get a lot of questions, John. In your opinion, a rising tide, meaning bullion rising, should lift all boats. Why haven't the gold stocks performed? I'm looking at the GDX is down 8% for the year. GDXJ down over 9%. The HUI is down 6%. And the XAU is down 10%. Why haven't the gold stocks responded?
They've gone the other way of gold, going up. Gold's gone up 7-8% year to date. There's been a number of reasons. One is, of course, competition from the ETFs. That's attractive. That's very liquid. But the second reason, and very telling, is that the gold companies, particularly these indexes, are heavily weighted to the seniors. The seniors suffer from two things. One is they're too big. You have to acquire companies to grow. They can't show organic growth. It's difficulty for Barrick, which produces 7 million ounces every year, to find another 7 million ounces the year after and the year after. And in fact, in Barrick's case, they bought a copper company, one of the major copper companies, for a big chunk of change. But what do? They use Barrick in particular, they're using cash. But in the past, what Barrick has done is when they reverse themselves on their hedge problems, is they put out $5 billion worth of paper. Or then you take Goldcorp last year, which bought in Andean Resources, they put out $3 billion of Goldcorp paper. Kinross, of course, put out 40% of their capitalization and went to spend $7 billion to buy Redback. In other words, these big mining companies are using their paper, and that's a big dose of dilution. So sure, they're growing. They're growing now when you look at it on a per ounce basis, but they're not growing when you take the total share capitalization, and it takes year, 2 years, sometimes as much as 3 years, depending on how much they put out, for the market to digest that. And I think that that's a big factor. On the other hand, if you look at some of the growth situations, be it Continental Gold or some of the other more junior situations, they have done 4 or 5 times increases. And so the market is quite smart. If companies are going to grow on either in ounces or reserves or in production, then they will gather that money. So my expectation is that particularly this year with I expect an average price of 2011 and 2011, I think that investors will realize that the cheapest gold really is in the ground, and companies like even the Barrick with 140 million ounces in the ground, when you do the arithmetic, they are very, very cheap. Even if you look at Barrick today on an earnings basis, is trading less than 10 times earnings. That's lower than the market averages, which is more than 19 times. So even on a value basis, these gold stocks look quite attractive. So my expectation is that sure, if they've stalled for a good part of this year, but pricing metrics, probably cheaper to buy these gold stocks on Wall Street than it is to now look at them go out and to feel looking